Okay, so the following is a clip from one of our classes on gaps in trading. We hold 3 live classes each week, plus have over 50 hours of content in our library, all for only $15. And so check out the description for more info and enjoy this video. Okay, so what people really want to understand a lot of the time about gaps in trading is that most trading of gaps is range-bound trading. This means that you'll be analyzing the range of pre-market trading and looking to profit from that in a number of different ways. But the key levels with almost every single gap that I see are the major support in pre-market, the pre-market high, and the previous day's closing price. These 3 levels will be very obvious when you look at a stock that, say, for instance, fills a gap, or a stock that bounces off of the pre-market high. These are mostly the ranges of pre-market moves. Again, these levels are the major support. You usually have one major support in pre-market that a stock continues to bounce off of over and over and over again. And you also get a lot of gap fills going right back down to that that previous day's closing price. And so when taken into consideration, you can see this example here. You can see the stock go right up to this high, bounce back down, form a major support right around here, this middle area, come back down to the previous day's closing price, bounce up from there, get rejected at the pre-market high, and you'll see stocks trading and moving in these ranges all the time. All right, so gaps. How are we supposed to trade these things? Let me see. So, like I said before, you essentially use pre-market, after hours, and historical data as your guide. So when you're trading the open, one of the most logical steps to take beforehand, and really when you're trading any type of strategy for the most part, is to mark down and document the after hours and pre-market support and resistance. These are most of the time going to be at the same levels I talked about in the previous slide, but the reason for this is because trading is based off of human thinking. It's based off of psychology. And so thus many traders are watching those extended hours levels and using those support and resistance areas as their guide in the trade. And so trading is one of those things where, it's okay to follow the herd. It's actually preferable if you follow the herd because that's what technical analysis is. It's trying to guess what everybody else is doing and then riding the wave with them. And so you want to do the same thing. And again, here's a decent gap fill example. You can see the stock moves up. You have the pre-market high here. You have the major support that was formed. And you have the previous day's closing price. And you can see when a stock fills this gap, it goes right back down to that previous day's closing price. Really obvious gap fill. And some of these examples are from today. I believe this one was. Let me see if I can pick up which one this was. I want to say it's either CODX or what was the other one? The crazy mover today. CODX, maybe EKSO. This might have been EKSO. And so you get these moves a lot in the market. Very obvious moves where the entire gap is filled on the way down. And you get similar moves whenever a stock is gapping down and it fills it on the way up. Alright, so another thing to take into consideration is volume. Volume in extended hours and why it's important. So volume plays a huge role in documenting support and resistance anytime, not necessarily even in gaps, but you always need volume to kind of confirm that support and resistance that you see in charting, but especially with trading gaps as well. The reason for this is because with no clear volume, the support and resistance areas will be less defined. They're going to be less clear. And so not only that, it also plays a role in how the stock acts after the bell. If the stock is gapping with no volume, it's usually much less reliable, choppy, and overall more difficult to trade. And honestly, I get this question a lot, which is whenever you see a stock gapping up, and you'll see these stocks all the time where the stock gaps up, but it doesn't move at all in pre-market. It doesn't move at all in pre-market. It's just, it kind of closes at one price, has no movement in between, and then just opens up at the, at a higher price. These are usually very, very difficult to trade. And the reason for that is because there's just no volume to accompany this move. And so with no volume, you have no guide in the trade. And it's just kind of a coin flip. You're not sure what's going to happen. And so to show you some examples of this, This is a stock with okay volume in pre-market. It's pretty decent volume in pre-market. You can definitely see the highs and lows, and you can see how easy it is to document these levels and then use them to base your trades off of. And so you have a really concrete, well-defined support and resistance documentation, and so you can really see where those levels are. And again, pre-market high, one of the major levels. The stock went right up to that level, got rejected, came back down. Once it finally held support, it broke out a little bit more, but it kind of shows how important that pre-market high is. And then again, you get a major support. It could either be this level or this level. Sometimes you're going to get more than one. But you could see how easy it is to kind of plan out your trade if this was the case, if the volume was decent enough in pre-market. And if you want to look at a stock that didn't have good volume in pre-market, we can look at this example. What stock would you guys rather trade? I know I would rather trade the first one because this is just a coin flip. All right, so let's look at some examples here just so you can see what we really mean by this. All right, so we get gap ups, okay? So with any type of gap, two of the biggest support and resistance areas to look for are, like I said, the pre-market high and the previous day's closing price. These are important because they signify the high and the low of each gap. And now, if you're looking to trade gap fills, these are very crucial levels because they're going to tell you where that gap is actually going to be filled. And the big thing you want to understand is that other traders are trading these gap fills. Other traders are looking to profit from these gap fills. And so it makes tons of sense if you think about it that once that gap is effectively filled, traders are going to be jumping out of that trade. If it's a short position and you're trying to fill the gap on the downside, short traders are going to be jumping out of that trade at the previous day's closing price because that's the most obvious level. And when enough people do that, it's going to cause the stock to bounce, which is what you see here with CRON. You can see it filled the gap. Once it got back down to right around that previous day's closing price, maybe a little bit underneath it where that support was the previous day, the stock bounced right back up. And so you want to go with the trend a lot of the times with these type of moves. It's one of the only things in life where going with the trend is a good thing. And it is in this case because if you can understand that most traders that are looking to trade a gap fill, they're going to be looking at that previous day's closing price. And most of the time they're going to be jumping out. And so the most logical reversal area in this type of trade is that previous day's closing price. And here's another example of it here, of using the pre-market high as that indicator. So you get the stock, you get the previous day's closing price, it opens up, comes back down to test that previous day's closing price, and then moves right back up to that pre-market high, runs right into some resistance there, pulls back, but when it finally breaks this pre-market high, and not only breaks that pre-market high, but it actually uses that level as support right here, if you can see that, then you get this nice big upward move. And so again, you really want to get into the habit, even if you're not trading a gap fill or anything like that, but the pre-market high and the previous day's closing price are extremely significant. These are levels that almost every other gap trader are looking at, especially the previous day's closing price and especially the pre-market high. These are levels that are very obvious, they're very concrete, and so it makes it easy for other traders to acknowledge those levels, see those levels, and then base their trades off of those levels. And so if you can understand that, you can understand the psychology behind it, you can use that as an indicator in your trade. And like I said, again, this one pushed up, came back down to the previous day's closing price, pushes back up to the pre-market high, tests it, but when it finally breaks, it actually holds that area as support right here where I drew this small blue arrow. It actually holds that pre-market high as support. Long traders are going to be jumping in this, and you can see the big push up, follow through. And then even later on in the day, when the stock pulled back some from this big upward move, where did it bounce off of? It bounced off of that pre-market high level. And so you want to get into the habit of documenting these levels, and you want to understand that when you're trading gaps, these are two of the most significant levels to look at. So here's another example of a gap fill. In this case, the pre-market high wasn't super relevant, but you have your major support level here, which you can even see the stock followed. Pretty nice VWAP fade here, and it pushed right up to that previous support level that you can use as your risk, maybe even if you're in the VWAP fade. And then it very nicely, very obviously filled this gap all the way back down to where? The previous day's closing price. And you're going to get these moves very, very often in the market. Here, let me erase this. All right, so yeah, you're going to get these moves very, very often in the market. And you can even see when it finally broke under that previous day's closing price, it did what? It held it as resistance. And so technical analysis 101, previous support tends to turn into resistance and vice versa. Previous resistance tends to turn into support once the break actually happens. But the goal in trading these gap fills, and we'll go over it a little bit later, is to take advantage of this shadow right here, this gap. You get this big gap where it's void of any significant support and resistance up here, and that's what we're taking advantage of in these gap fill trades. But we'll go over it a little bit later. All right, so gap fills, like we just kind of went over, but gap fills occur when a stock gaps up or down overnight, yet it fills the entire gap the next day, effectively ending right back where it started. And these are super common in trading for a number of different reasons, and we can go over that now. Shadow fills. So when a stock fills a gap, it can happen because of a space in said gap that, like I said, is void of support and resistance. For both gap ups and gap downs, this typically ends around the previous day's closing price, although it's not always the case. Nothing is 100% in trading, nothing is always going to work. But a large majority of the time, I would say, when a stock fills the gap, it's going to at least bounce some at that previous day's closing price. And that's usually a level I look for. If I'm looking to take advantage of an all-day fader or something like that, I can use that previous day's closing price as a very self-evident profit target. You know, depending on the range of the stock and how much the stock is gapped up, it all depends. If a stock gaps up 3, 4, 500%, it will very rarely fill that entire gap the next day. But if a stock gaps up 30 cents or so, 30 or 40 cents, and it's not a huge gap, but it has some very obvious levels like the pre-market high and the previous close, then we can, you know, fairly safely set that reward target of the previous day's closing price. And when you're setting a reward target for anything, this is important to understand, is that whenever you're setting a reward target for anything, you're trying to look for the most obvious reversal point. I'll say it again. When you set a profit target for something, you're looking for the most obvious reversal point. You're looking for the level that is the most obvious for that stock to go the other way against you. And honestly, it's the same with a risk level. You know, you have your risk and reward levels. When you're setting a risk level, you're looking for the most obvious reversal point. Because if the stock breaks that level and continues moving up, then you know it's time to exit the trade. But the goal is to take advantage of that and set it as your risk and reward. So I hope that makes sense. Just wanted to touch on that. And again here we have the gap fill. You see this big area that is void of major support and resistance. Okay, so, you know, yeah, you have some support here. Maybe you could have started that void here. But once you get under this level here, there's no major support and resistance. The volume's very low. It didn't really have too much volume down here except for maybe right here. And so you don't really have any major levels as your guide. And so when the stock actually starts to fill that gap, that's what it's doing. It's filling, it's coming back down. Why is it coming back down? Because it's void of any major support in this area. It has nowhere to bounce off of. Other traders don't see a level that they can base a long trade off of because there's no really major support or resistance. And so long traders are going to wait to get in. And short traders are going to see this gap to be filled, which means pretty good risk reward. And they're going to start attacking this trade on the short side. And so you want to understand that most gap fill strategies are taking advantage of that void, that shadow in the trade, in the chart that doesn't have much support and resistance there. That's what most people are looking for in these type of trades, and you can see why. Because if you look at this chart, you can see how well it actually follows these levels. Okay, I'm back. Sorry about that, guys. Just need to get some caffeine in me. Okay, so yeah, so we're with gap fills, we're essentially looking to take advantage. Right, exactly. So when you see a stock gap up, right? You see a stock gap up. Everybody in the trade is long at that point, and when the open happens, you know, the thing you want to understand about this, like Casey said, is that when you're trading pre-market and after hours, you're going to get worse fills, the spread's going to be worse, and it's going to be harder to exit that trade. And so some traders, as Casey mentioned, are holding the stock overnight. And when they hold it overnight, the next morning, they're going to wait for the open to happen because they are going to be looking for favorable exits in that trade, right? They don't want to exit in pre-market and extended hours, because if they exit in extended, or if they try to exit in pre-market and extended hours, a lot of the time there's going to get much worse fills. And so what they're doing is they're waiting for the next day. They're waiting for the market open the next day so they can get a little bit more volume and an easier exit in the trade. And what happens when long traders sell their positions? It makes the stock drop, and it kind of squeezes the stock down. And like Casey mentioned, a lot of times that's what's happening with a gap fill, is that those traders are covering their positions, and that's dragging the stock down. All right, so trading the void in the shadow. In order to trade the void, first you must have a stock that pushed up substantially in pre-market. If not, the void won't be there, obviously. Once you find a stock that does this, document the major support and resistance levels. Again, I probably sound like a broken record, but it's kind of one of those things you really want to understand with trading gaps, is that those significant levels are there and they're very obvious, which is the pre-market high, the previous day's closing price, and any major support in between. And so if you can document those three levels and you look at examples of gap fills and gap and goes, it will make tons more sense. And so again, get into the habit of documenting the pre-market high, the major support in between the pre-market high and the previous day's closing price. Because that will make the gap make way more sense than if you look at it without those levels documented. And like this says, the main goal is to look for a break, kind of like Casey said here. Casey said if it holds pre-market support, it can gap and go. That's exactly right. And so the main goal when you're trading a gap fill, a gap fill or a shadow fill, is to look for a break underneath the major support level with a reward target of possibly the previous day's closing price. It all really depends on the range. A lot of times that's going to be unattainable, and you can just use major support in between there. But again, like this says, you can also use the high of pre-market, although many times the stock will have major resistance there. So it makes sense to target the major support level underneath underneath that and really attack the range of the gap. And so here's a good example from NVIDIA today. We had a few gap fills today, and this is one of them. And so you can see the pre-market highs up here. It's not super relevant when you're looking to really attack this on the short side. But you have this very, very obvious, very defined. But again here, so like I said, you want to look for the break of the major support. You have this big major support here. And you want to wait for that support to break. You could use the pre-market high, but it's not going to be as relevant. So you look for this major support in between the previous day's closing price and the pre-market high, and you look for a break underneath that area. Once it breaks underneath that area, you can anticipate the bounce at the previous day's closing price. Why can we anticipate a bounce there? Because at that point, once the stock reaches down to this level, it has effectively filled the entire gap. It filled the entire gap from point A to point B. And again, it's void of any major support and resistance in this area. Sure, you have a little bit here, but I wouldn't think it's super relevant. You have much more confirmed support level here. It gets confirmed 1, 2, 3, 4, 5, 6 times in pre-market. And so yes, we have a few little areas here, but it's basically void of any major support or resistance. Yeah, perfect example of it. Right back down to the previous day's closing price and a very obvious bounce. But yeah, great minds think alike, Casey. All right, here's another example from today. EKSO, I believe this was. And again, you have the pre-market high documenting the top. You have the major, very obvious, self-evident major support here at about, what is this, $2, which is again a whole dollar, which gives it even more, confidence in it. And then you look at around the previous day's closing price. Really, this one went almost down to the cent to the previous day's closing price. In this case, I think I used this level because it had some support there. But it really goes down right here in pre-market to a previous day's closing price. And so these gap fills happen a lot. And again, you could see the area here, which is void of any major support or resistance. There's actually no support or resistance here except maybe this level. And so it's void of any major support and resistance, and you get this really nice, very obvious gap fill. And something to really touch on here is that a lot of times these stocks are going to be terrible stocks. You know, a lot of times, not Nvidia, obviously. Nvidia is a good company, but a lot of times you're going to get these cheap, low float penny stocks that do this. And EKSO is a good example. I think CODX pulled a similar move, although I don't think it filled the entire gap. But these are really the gap and fail strategies that I look for, because these just happen so often. It's also where kind of my option strategy revolves around, which is looking for overextended moves with terrible cheap penny stocks and trying to just buy put options on them and wait for them to come down. And the strategy is still very similar, but you get these moves happen over and over and over again in the market. You know, you get these big moves where a stock gaps up in a big way, fills the entire gap, comes right back down to the previous day's closing price. Very textbook, like Casey said. It happens a lot. And like I said a bunch of times already, you want to pay attention to the pre-market high, major support in between that, and the previous day's closing price. And so again, what you essentially want to understand is that this is a range strategy. You're taking advantage of the pre-market range between major support and resistance. At the same time, though, they can be traded with a few different strategies. So again, this is range-bound trading. You find that range by documenting those levels I've mentioned a million times already. And so you can find that range in between those levels and look to really attack that range, because a lot of times the stock will move in that range, and you can anticipate the reversal at the previous day's closing price. You can anticipate a rejection at the pre-market high a lot of the times, and if it breaks either one of those levels, you can really just look for it to hold those previous levels as support or resistance. And so it's a range-bound trade, and that's what you really want to understand. And if you actually start thinking about it with that regard, then it becomes a lot easier to understand, is that this is a range-bound trade. Gaps are range-bound trades. With gap fills, you're taking advantage of that range of the stock moving between that range. If it's a gap and go, a lot of the times you're taking advantage of a break of that range. And so both instances, it's a range-bound strategy, or it's a range-bound type of trade. All right, so we can look at a few strategies you could use to actually take advantage of gap fills. All right, so the first one we can really look at is the support break. So documenting, hold on, let me make sure, I'm trying to make sure I remember to hit record here. Okay, yeah, I did. Okay, so documenting the support in pre-market and intraday and trading the breakdown can be a viable strategy. With this, you want to wait for the break of the major support, then wait for the bounce to test that previous support. That's where you can enter, very kind of similar to a VWAP bounce, a VWAP fade, where you wait for it to bounce to that major support. In this case, it's just the major support of pre-market. But again, you want to wait for the break of the major support and then wait for the bounce up to test that previous support. You know, you always want to wait for it to hold as resistance, but you enter it at that level. And then you set your next resistance area up as your risk and your next major support underneath as your reward. And the main goal can also be set at the previous day's closing price. Again, with these type of moves, you don't want to set an unrealistic, unattainable reward target. And so that's why it says it can be used at the previous day's closing price. But if the stock gaps up, 3, 4, 500%, it may be unattainable. And so you want to understand the range of the stock in general. But just to show an example of this. So this is, I believe, CODX from today, if I remembered correctly. And so again, you have the major support here. You have the break of the major support down here. You can enter the move on the bounce up to test that major support and then look to take advantage of it, possibly filling the gap. And so you have the support break here, very obvious support break, confirmation multiple times in pre-market and during intraday trading, and then you finally get the break. Once it finally breaks, you can wait for a bounce up to test this level, and that's where you can enter the trade. The good thing about this type of trade is that your risk is only up to this level here. Let me get out the pointer. Again, so your risk is only up to this level here. So it's a pretty tight risk. It's only from here down to here. So very tight risk, because you can see you have confirmation in pre-market and an intraday movement. So your risk is tight up here. You finally get a break, entering here, tight risk. And then you can set your first reward target at the 250 level, basing it off of pre-market support. So here's pre-market support. It's also the $half. If you caught our half and whole dollars class, the more support confirmation, the better. And here, it's major pre-market support, and it's also the $half of 250. And so it's a reasonable area to take profits, getting 1-to-1 on that first target. And so when we finally get that break, again, we want to look for that area to hold as resistance. You can see it hold as resistance here. And our second profit target, we can shoot for $2 down here. And again, why is $2? Why is this the second reward target? Well, not only is it the whole dollar of 2, but if you go look back, it's also resistance in pre-market. And so if you take profit there and you still want to let it keep going, you can go to the third profit target. Again, why is this level a profit target? 1, because it's the $half, it's 150. And 2, if you look over in pre-market, it had major support there as well. And so obviously you could try to take advantage of the entire gap fill, but that's how I would kind of plan out the trade. Tight risk, decent bounce up here, very obvious and defined support break, and just look for it to fill the gap on the way down. This one, I don't even think this one did fill the gap, but that's how you could approach it, looking to take advantage of the entire move. The important thing to understand here is that you got to take big enough size in order to scale out this much if you are looking to scale out this much. But if not, you can just get in, take profits once, and let the rest go break even until it gets down to your desired reward target, or you're not comfortable in the trade and you exit. Does everybody understand what I mean by the support break, looking for the gap fill? Kind of says at the bottom is that, remember, these strategies can all be used to take advantage of gap fills within the pre-market range. You could really use any strategy you like as long as you understand the range that that gap gives you. The reason gaps are very looked upon and very popular trading strategies is because they give you a very defined range of that stock. You have a very defined range with gaps because you have the pre-market high and you have the previous day's closing price. And a lot of times you're going to have a void in between there. And so you can look at that range and it's very self-evident. It's very defined. You can really see it. And that gives you an opportunity because whenever you can really see it, other traders can really see it as well and really attack that range from the gap. And so that's why gaps are so popular, is because they're very obvious. The range is super obvious with gaps. It's because you have the high and the low. And it's not super complicated. And so, yeah, just to name a few, just when trying to take advantage of gap fill strategies, you can use the VWAP fade or rejection, the opening range breakdown, like I've been doing, opening range breakout, 1 minute range breakout, 1 minute pullback. You can really use any strategy as long as you're taking advantage of the range, and they'll present themselves within that range, giving you very obvious levels to follow. Wait, I went a little bit too far here. All right, so here's an example on, I believe, ACB of a VWAP fade. You have the major pre-market support right here. It confirmed that level. Let's mark down how many times it confirmed. It confirmed that level here, 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 here. So you get this very obvious support level in pre-market. And you're looking to attack that range in between what range are we looking to attack, guys? Quiz time. What are the two levels in the range we're looking to attack with these type of moves? That's right, Scott. All right, yeah, we're looking at the previous close and the major support. And in this case, you see the major support here. You see the previous day's closing price. And so, for instance, if you... sorry, guys, my son's back shuffling. Hold on. My son has this outfit that he makes us put on him every single night. It's a Sonic shirt and pants and then dinosaur slippers. And so what you guys hear is him shuffling around with his dinosaur slippers. Yeah. But yeah, so we're looking to attack the range of the major support in pre-market and the previous day's closing price. And so, for instance, when we see this VWAP fade here, if you know the VWAP fade, everybody probably should after taking classes, but you can see it's actually a rejection. But you can see a break underneath the VWAP, a pull back to the VWAP, and we're looking for, we can enter the trade here, and give ourselves a very decent and obvious profit target of that previous day's closing price. We can look for the VWAP to hold, even if, for instance, in this trade, right, even if we just gave ourselves a risk of way up here, which is the previous high of the day or the pre-market high. Even if we use this level as our risk reward is still pretty decent. Our risk would be here. That would be our risk. And then our reward would be here. And so even if we're just trading it with that, pretty good risk reward in this trade. And again, you can see when it actually does bounce up here. Let me erase some of these. You can see when it bounces up here and gets rejected at that VWAP, the previous support from pre-market, the major support in pre-market, holds as resistance right here. And that keeps it down. And since it's kind of void right here of any major support or resistance, you can't really see any significant or major support and resistance right here, then you have a very obvious profit target where? At the previous day's closing price. And you can see again, this stock moved in a very obvious way right down to that previous day's closing price before bouncing back up. And so this is how you can kind of use your own strategy within the range of the pre-market gap and really look to attack that range. You know, you can really see the range here. It's very obvious. You have the shadow here, void of any major support or resistance, and you can really attack this range, looking to take advantage of a gap fill strategy. All right, so the next thing we can really look at are gap and goes. And so this refers to when a stock continues in the same direction as the gap. For instance, if a stock gaps up and continues in a bullish trend after the open. And so this is just looking to trade the stock in the same direction of the gapping. Of the gap. So you're looking to trade the stock in the same direction of a gap. And so if a stock gaps up, you're looking to go long. And if a stock gaps down, you're looking to go short. That's all gap and go means, is that you're looking to trade along with the gap direction. Like this says, for longs, I like to wait for the stock to find support at either the pre-market high or the major pre-market support as confirmation. You know, that is something I really want to see. If I'm looking for a gap and go strategy, the pre-market high and the major support in pre-market are huge because those are the levels that everybody else can see, and that's when it's breaking out of the pre-market range. You know, that's really what a gap and go strategy is a breakout of the pre-market range. And so when a stock holds support at that pre-market high and then continues moving up, it's confirming that move in that direction. And so with shorts, I like waiting for a rejection at the pre-market high. If the stock breaks under the low of pre-market, I like that area to hold as resistance as confirmation. Kind of the same thing with the gap and go, just reverse. So instead of looking at the pre-market high with a gap down, you're going to be looking at a pre-market low. And instead of waiting for the pre-market high to hold as support, you're looking for the pre-market low to hold as resistance in that trade. Like this says, you'll hear people talk about the line in the sand in trading. A lot of times those lines in the sand are at the previous day's closing price, the pre-market high, and in the pre-market low. All right, and so here's an example of a gap and go. Again, you can see the pre-market high right here. Huge gap, big move. You have some major support and pre-market down here where the stock actually found. And so when you get this, you get a break of the pre-market high. It pulls back down to test it. And like I said, whenever we get these pre-market high breaks, what we really want to see is we want to see that pre-market high level hold as support. We actually get that here. It breaks it really nicely, holds that level of support, and then continues to push up. Again, when it pulls back down here to test that level, where does it bounce? At the pre-market high. You know, and if you think about why technical analysis works, it works because other people think it works, then this is the most obvious level to watch, because this is probably what everybody else is looking at as well, because you have the major support, you have the major resistance in pre-market for the rejection, making it the pre-market high. You've got the confirmation when it breaks here, and so tons of traders are looking to take advantage of this move. And a lot of long traders are jumping in when it bounces here. And if you can also use this level as a risk. You know, for instance, if you're long in this trade down here and you see the stock break the pre-market high and then push up, you can use that level as your risk and say, okay, well, if it breaks underneath the pre-market high, that's when a lot of short traders are going to be attacking it. That's when a lot of long traders are going to be exiting. And so I can use that level as my risk. And then again, here's an example, a very good example of a pre-market low. So when you get a gap down, you could document the pre-market low. And so that's what we get here. We have the very obvious pre-market low down here. But yeah, so we have this very obvious pre-market low right here. And a lot of traders are going to be looking at this level. We get bounces right at that level in pre-market here. Let's see. We get bounces right around that level here. We get it to test. Finally breaks, but it can't hold that level as resistance. But when it finally starts to hold that level as resistance, we get a big, nice move down. And so this is it testing that pre-market low, which is right around here. And so when it finally holds under that, it breaks down big. And you can see this big downward move here. This big, huge downward move here. And so that's what we're looking to take advantage of, this range break. It's trying to break out of this range from pre-market. When it finally does that, you get a big confirmation down move right here. All right, but yeah, any strategy really you can think of, as long as you're trading it based off of those levels. Opening range breakout, one that I've been doing a lot. Red to green move or washout long. These have been super reliable with AMD at least. 1 minute range breakouts, those happen a decent amount. VWAP bounces, resistant breaks, so forth and so on. So really any strategy you can think of. But like a good example of like the VWAP bounce is, let me see if I can pull it back up, is here on, I can't remember what this stock is, but again, you could look at this VWAP bounce here, looking to take advantage of a gap and go. You can see the bounce here at the VWAP, very nice move up. Definitely got the profit target, maybe a little bit more. And so you see these moves in this a lot. And yeah, there's lots, you could really trade any strategy, that you like, as long as you're giving yourself favorable risk and reward levels. But yeah, guys, if no questions, I'll go ahead and close it down, and we'll see you guys tomorrow morning.